So I think in general this year we're expecting a relatively benign picture despite the tariff risk, so long as I think policymakers stay on the front foot of the tariff tensions coming out of the US administration.
China stands at a critical juncture. Its economy, once a powerhouse of growth, faces a complex web of challenges, from a slowing real estate sector to rising geopolitical tensions. The year ahead presents both opportunities and uncertainties. And of course, we can't ignore the elephant in the room, the impact of Trump's China tariffs. And to understand more about China's economic outlook and what strategies Beijing will employ to navigate this complex terrain, I'm joined by Louise Liu, China economist of Oxford Economics. So let's start off with Trump tariffs. What sort of impact is that going to have on China's economy?
Well, from a very direct perspective, the direct macro impact is actually quite small. So if you think about the Chinese economy, about a fifth of it is attributed to exports, of which 15% goes to the US. So even if the Trump administration imposes something quite hefty, such that all of the US-bound exports go away, we're only talking about 4 trillion RMB in losses. So that's about 3% of China's GDP. So in macro sense, it's actually quite a small impact. But of course, the fact that we are in a new administration, policy uncertainty is quite high. So the impact is likely to come through market uncertainty and what that means for investor sentiment onshore.
And how has Beijing been reacting as a result of announcements? And lately we're hearing about this blanket 10% tariffs.
Well, they have actually been quite measured. Measured is the word that we hear very often when it comes to policymakers in China responding to geopolitical tensions offshore. They, at the very beginning, they put out a statement talking about how they feel that these tariffs are discriminatory, they're contravening some of these global trading rules. And then, of course, when the tariffs did come into effect on the February 4th, they did put out a somewhat orchestrated list of tariffs on about $14 billion worth of US exports to China, as well as a range of other non-tariff measures. I would say in general, the tone I'm getting from Chinese policymakers is that they're quite prepared this time around for at least another round of trade tariffs and trade war with the Trump administration.
I suppose we can't use necessarily the word retaliation, but in terms of China, do they have any holding any aces? What cards do you think Beijing holds?
Well, I think it's probably worthy to note that we don't think they'll be as combative this time around as they were in 2018 and 2019. And I think this time around, it does seem like some of their preferred strategies has been to look into how they could leverage their dominance in the supply chains of, for instance, critical materials, which actually are key inputs into some of these high-end manufacturing products, for instance, for the defense industry or for solar panels. So they could potentially leverage some of their dominance in that area by restricting the export of critical materials. They could also be a bit more punitive on, for instance, American interests onshore. So that could come in the form of perhaps more stringent rules for American companies onshore. That obviously raises the business operational risk of operating in China.
So we were talking about the delicate balance that China has to take when it is reacting to the pressures from overseas. Domestically, they are faced with a lot of challenges. What are some of those areas that they should focus on?
I think at the heart of their domestic challenges, is really the housing crisis. We've talked about it for a few years now. China is at the midst of a housing correction that could take years. We know from global precedents of housing boom-bust cycles that this, could have very material negative effects on the rest of the economy through negative feedback loops on consumer spending, on investments onshore, and in the case of China, on local government finances. So to the extent that they could slow the pace of house price declines, that could have an incrementally positive impact on the rest of the economy. So that's really where most of the policy focus has been, I think, for the last 2 years. Solving that would really solve the root of many of the problems that they face today, such as weak demand, uncertain investor confidence, and a lot of these other ripple-on effects that the economy faces.
Slowing down the decline for the housing demand or rental, I suppose, is that through stimulus or other measures as well?
Well, there are many ways to go about really addressing the housing problems in China. Stimulus is one way. And when we talk about stimulus for housing, we're talking about demand-side stimulus to stimulate housing demand, but also supply-side stimulus, such that you're providing banks, especially in China, with the ability to take on some of these negative loans that's coming out of property developers and really rescuing private developers to a certain extent. So there are different forms of stimulus that could come about when we think about solving the housing crisis in China.
One of the other issues, and let's move to talk about currency, which China has deployed in the past, which is based off to boost their demand for their exports, is to devalue their currency. But this time around, they're probably going to take a slightly different approach, do you think?
We think that would be a less preferred policy too this time around, mainly because of the risk of capital flight this time around compared to perhaps 2018 and 2019. By our estimation, about a 10% increase in U.S. tariffs requires about a 5% depreciation in the Chinese yuan in order to offset the impact of higher prices. So 5% is actually quite a lot in terms of the political tolerance for a weak currency.
Another big risk, I suppose, is deflation. China's been sort of in this deflationary spiral, if you will. What are the further risks associated with this?
Well, weak prices are traditionally good for consumers because we like low prices. In China's case, weak prices is actually a symptom of, on the one hand, very weak demand, and on the other hand, overcapacity issues, oversupply in some sectors. So really, the problem of that is that in aggregate lowers the total output of the economy, and that has a further impact of lowering prices overall. So that is what we call a deflationary spiral, a deflationary loop. Now, the problem with that is that raises the bar for how effective stimulus can be. If consumers are trapped in a deflationary loop, they would not really be that incentivized to borrow even when real rates are low. So the PBOC, or central bank, could continue to ease rates, bring down their rates, and you could have investors and borrowers not quite willing to take up that offer of low rates and low financing costs. So that creates the kind of aversion to invest, the aversion to spend, and that has that deflationary loop, as we say. Now, the challenge of getting out of that is really, in our view, aggressive stimulus. The commitment to really stay on the easing path for much longer, the fact that the government would continue to be the spender of last resort, that is, I think, what consumers and investors onshore are hoping to see from the Politburo this year.
So you spent a lot of time previously in China, specifically advising China's Ministry of Finance about its sovereign credit rating. Can you give us some insight into what it's like on the inside of PRC?
Well, policymakers in China they're like engineers, right? They're not like policymakers in the U.S., which are perhaps business-minded or perhaps financiers. So in the policymaking apparatus in China, from an engineering perspective, debt is not a good thing, right? We want to reduce our debt burdens. We want to not accumulate debt. We want to not spend more than we can take on in future. I think policymakers in China are well aware of the challenges. They are aware that in such a situation, especially using the Japanese experience in the 1980s and 1990s, a big stimulus, a big expansionary boost would be most needed.
One of the other things you mentioned also is about the kickstarting the economy through stimulus. That might not be as effective, perhaps, given the population really likes to save.
Yeah, I think that's probably true. At about 31% of personal disposable incomes, that's actually one of the highest savings rates in the world that China has. Just for context, that's about 4% in the U.S. and about 10% in Korea. I would say that it's not so much the high savings, but over the last few years, we've also seen changes or shifts in consumer preferences.
Do you think AI, such as DeepSeek, which has been all over the news, does that reshape China's infrastructure and what it looks like? Is that going to give a boost to the economy?
For sure. I think the development of DeepSeek and the news around that, I think that's bringing forward a lot of our assumptions on what AI is doing to the economy. Previously, we were thinking perhaps AI is a development that would where the macro impacts would be ripped in maybe in 10 or 20 years. But the development of DeepSeek has really brought forward that timeline. And the reason I say that is that if we think about the internet boom in the 1990s and think about the US experience in that, it takes roughly about 10 years for adoption rates in a frontier technology to be fully, I suppose, more dispersed throughout the economy. And that brings about pretty meaningful improvements in productivity. So we are expecting the same for China over the next 20 years. And by our estimates, the AI generative technology would actually boost the economy by up to 7%.
And given these headwinds, what is your outlook for 2025? Will they be able to weather all of these challenges for the next 12 months?
Well, we think China comes into 2025 with a very strong stability mindset. And we expect that that stability mindset will perhaps drive the government to another pretty aggressive growth target for the year. So I think in general this year we're expecting a relatively benign picture despite the tariff risk, so long as I think policymakers stay on the front foot of the tariff tensions coming out of the U.S. administration.
A big thank you to our special guest, Louise Liu, China economist, Oxford Economics. Thank you very much for tuning into the latest episode of I See Your Trade. I See Your Trade is brought to you by IC Markets, a leading high-performance trading provider. Trade up to IC Markets. See you next time.